Audio unclear.
I'm changing my volume. Just give me a second.
Yeah, if people could speak up a little bit, it's hard, we're having difficulty hearing.
Okay,
That's better.
great. Ms. Dewey, who do you have with you?
My co-counsel Bradley Craigle with me for respondent franchise tax source.
Okay. All right, so I was going to say some of the rules for our hearing today for the, because it's electronic, is that keep your mics muted or your phones muted unless you're speaking. If you wish to say something, wait for whoever's speaking finishes and then unmute yourself, let me know, and I'll let you know when to proceed. Introduce yourselves before you speak. Speak clearly at a regular pace. Our court reporter, Lynn Alonso, will be transcribing today's hearing. The transcript of the hearing, along with the live stream of the hearing, will become part of the official record for this hearing. Because we are live stream, anything that is put on the screen is available for public viewing, so be careful about that. Before we go on the record officially, I want to go over some of the things we've discussed at the pre-hearing conferences, and just to make sure we're on the same page. As far as witnesses are concerned, I'm going to swear John Harper, Gene Brockman, Bruce Brockman, and Sandra Lang in once we get started. Franchise Tax Board, do you have any witnesses?
No.
Thank you. Issues and facts. We received a joint issue and fact statement from the parties dated August 4th. They will be entered into the record once we get started. As far as issues are concerned, the case involves the deductibility of $1,925,599 arising from the settlement of a Unfair Practice Act lawsuit against Bay Guardian's competitors. Taxpayers has advanced at least two theories for the deduction, either as a bad debt or a net operating loss, quote, NOL, unquote, carryover deduction, or under one of two statutes, Internal Revenue Code 186 or Revenue Tax Code Section 24678. Regarding Section 24678, Franchise Tax Board submitted a request last week for further briefing on that issue, which we did not grant because it's too close to the hearing. We've advised both parties to address that section today, and if need be, we will have post-hearing briefing on that particular issue. And is everybody in agreement as to where we stand regarding the issues in this case? Mr. Harper?
Yeah, we agree.
Thank you. Franchise Tax Board?
Yes.
Thank you. Exhibits, again, we'll go into this later on with the informal, the recorded process of the hearing, but based on the pre-hearing conferences, there's no objections to Franchise Tax Board's Exhibits A through W. We did receive on August 12th a memo from Franchise Tax Board with a general objection to all of Bay Guardian's exhibits. Is that correct, Mr. Harper?
Yeah, we didn't agree to their exhibits and they disagreed with all of ours.
We'll go into that after when we get into the official portion of this case. Just want to know where we stand. Franchise Tax Board, is that correct?
As to our objections, I wanted to clarify that we are actually only objecting to the cover letter submitted with appellant exhibits. We were not objecting to the exhibits themselves.
So exhibits 1 to 8, there are no objections, just to the about 4 or 5 page cover letter.
That's correct.
Okay, that makes things a little bit easier. So that's fine. As far as timing for this hearing, Each side is allocated 45 minutes. Mr. Harper, we had discussed at the pre-hearings that you could divvy up the minutes, 30 for your presentation and 15 for your rebuttal, but that's up to you. You can do 20, 25, 25, 20, whatever, it's in your discretion, okay?
Okay, okay.
Yeah, well, it's up to you, and obviously, you don't have to use all your minutes if you don't need them, and oftentimes, less is more. About right after you finish your rebuttal, Mr. Harper, the judges will take a 5-minute break to discuss whether we will need additional briefing after the hearing. Please do not go away. Stay where you are. We'll be finished really quick and we'll come right back to you. So just to let you know that. And any questions, Mr. Harper?
No.
Thank you. Any questions, Ms. Dewey?
Not at this time.
Thank you. Mr. Harper, are you ready to proceed?
Yes.
Ms. Dewey, are you ready to proceed? Ms. Dewey, are you ready to proceed?
Yes, we are ready.
Then let's make it so. Ms. Alonso, we are ready to start the record on OTA hearing number 18063341, appeal of Bay Guardian Company, taxable year 2012, or taxable year ending April 30th, 2013. It is approximately 10:45 a.m. in Sacramento. We are conducting this hearing electronically. We have parties online, parties on the phone, parties on audio only. With Judges Aiken and Rosas, I'm Judge Leung. We will be making the decision on this case. We will be making this decision as equal partners and equal participants. For purposes of the record, may I please have the parties introduce themselves, starting with you, Mr. Harper?
John Harper, I'm the CPA for the Bay Guardian.
Thank you, sir. For the Franchise Tax Board?
Darcy Dewey, attorney for respondent franchise tax board.
Okay. Mr. Harper, will you, Ms. Lang, Jean Brugman, and Bruce Brugman, please raise your right hands. Do you swear or affirm that the testimony you're about to give is the truth, the whole truth, and nothing but the truth?
I do.
Thank
I
you.
Yeah, I do.
Thank you. Thank you. Okay. Some things we need to get enter into the record. We're entering into the record today the pre-hearing conference minutes for August 5th and July 2nd of 2020. Enter into the record the joint issue statements and joint fact statement. And the issue statement will be amended. It will be the issues of whether the $1,925,599 in deductions taken by Bay Guardian Company on their tax return for taxable years ended April 30th, 2013 was properly denied by Franchise Tax Board. The deductions were taken by Bay Guardian either as a bad debt or part of an NOL carryover, or one of two other statutory possibilities, either sections 186 of the Internal Revenue Code or section 24678 of the Revenue and Taxation Code. Exhibits, Franchise Tax Board's exhibits A through W are admitted into the record. Bay Guardian Company's exhibits 1 through 8 are admitted into the record and admitted into evidence. As far as Franchise Tax Board's objections to the cover letter, Ms. Dewey, what would you like to say about that?
As we stated in our memo, we object to the cover letter as an improper additional briefing under OTA Regulation 30304. The additional briefing was not requested in writing, was not served on the FTB, and does not state any facts, arguments, or other grounds for good cause for the additional briefing.
Mr. Harper.
I'm sorry, I couldn't understand anything she said.
Okay, thank you. Ms. Stewart, I think you need to get a little bit closer to the mic and repeat your objections.
Okay. So as stated in our grounds in our memo of August 12th, the improper additional briefing under OTA Regulation 30304. The additional briefing was not requested in writing, not served on the FDB, and does not state new facts, arguments, or other grounds or good cause for additional briefing.
Thank you. Mr. Harper, did you get that?
Yes.
And your response to that?
Well, it's without merit. When we first talked, I asked you what information you had. You know, we've given the Franchise Tax Board massive amounts of documents. I did not know what the court had. And you told me basically you had nothing. And then you gave me till August 5th to supply the court with information. We had not submitted a brief before that. This is, or any exhibits before that. You actually specifically told me our exhibits would be numbered, and the FTB's exhibits are alphabetical. This is our original briefing based on your instructions. And basically, you told me, give us what you want to have in the file. That's what we've done. I don't, what doesn't she like? I mean, we tried to do everything you told us to do, and we did it well before August 5th. It was mailed by certified mail. We followed up with the OTA to make sure they got it. And then we actually even emailed it to the OTA to make sure you had it twice. And then I was told by Susanna in your office that they would forward the email to the Franchise Tax Board, and they got it well before August 5th. So, again, we tried to do everything you told us we had time to do, and we did it well before August 5th.
Thank you. Okay, what I'm going to do is we're going to admit into the record, into evidence, your exhibits 1 through 8. As far as the cover letter is concerned, I so understand what you did, Mr. Harper. We did not ask for further briefing, but I worked in private practice before also, and it's very unusual for just to slap together some exhibits and send it off. You gotta have some sort of cover letter explaining things. So I get what you did. It is a bit lengthy for a cover letter, but basically what you said in the cover letter, you basically summarizing your exhibits, which is, to me, there's no harm, no foul. What I can do is that we'll look at it as correspondence as part of the file, and we'll get it into the case that way, and we'll put the exhibits as exhibits 1 through 8. And Franchise Tax Board does nothing in the cover letter that does not appear either in their exhibits or in your exhibit. So they're part of the record. So I'm going to say, if you really want a ruling, the objection is overruled. The exhibits come in, the cover letter is correspondence and it's part of the file. That'll be my final ruling on this. And with that, I think we are ready to start. Each party has 45 minutes for their presentations. Mr. Harper, you may begin at your convenience. Thank you.
Okay, I would like to thank the court for giving us the opportunity to plead our case. We are not lawyers, so we're apologizing in advance for any deviations from normal protocol. Any errors in procedures are due to lack of experience and not due to lack of respect for the court. Please feel free to stop me or ask questions at any point in time during my statement. Here on behalf of the Bay Guardian, a free weekly alternative newspaper circulated in the San Francisco Bay Area since 1966. Note, it's a free paper with its only source of income coming from advertising. They were victims of predatory pricing by a competitor, and a future lawsuit followed. The company was forced to reduce its prices below cost to compete. The company advised by its attorneys to track this reduction by reporting revenue at its regular price. This reduction would constitute damages. The business was ultimately sold and the accounting records deleted by the new ownership. And this has led to the challenges in substantiating the bad debt. We hope that common sense, review of the financial statements, and the testimony of the controller will convince the court of the validity of these amounts. Before we go any further, again, I just want to note that the IRS has never audited or had any questions with the exact same numbers and the exact same tax returns in the exact same years. We also want to bring to your attention how we got here. This case dates back to 2014 and had been transferred to the New York City Appeals Office of the Franchise Tax Board. The result of the New York hearing was never revealed, and the case was transferred back to Sacramento. We wonder why the FTB would go to the trouble to transfer a case from Sacramento to New York, hear the appeal by two FTB appeal officers, exchange correspondence, and then transfer the case back to Sacramento without issuing a report. We speculate that the two appeals officers could not agree, which means one of them agreed with our position, or secondly, someone higher up in the Franchise Tax Board disagreed with their conclusion. The Bay Guardian has admittedly followed poor accounting practices by overstating revenue to calculate damages in a lawsuit. Basically, the FTB wants the company to pay tax on income it never received. It's as simple as that. It's as basic as that. They want us to pay tax on money, cash that was never received. Okay. Beginning in 2004, the Bay Guardian discovered its main competitor, the San Francisco Weekly, had been selling advertising space in its newspaper at a price that was below the cost to produce the advertisement. The San Francisco Weekly started this practice with the sole purpose of driving the Bay Guardian out of business. This practice is known as predatory pricing and is in violation of the California Unfair Practices Act. In order to prove the illegal acts of the San Francisco Weekly and substantiate the amount of the damages, the Bay Guardian was advised by its legal counsel to account for revenue as follows. We want to put a picture up on the screen for everybody. We're trying to put it worked in practice. Okay. This is just an example of an ad using $100. So you record revenue at the regular rates, which is $100. You bill the customer at the lower rate, which is the rate that the San Francisco Weekly was charging, which was $80, but then $80 of accounts receivable, and then an additional accounts receivable for the unbilled discount, $20. So we're recording 100 of revenue. We're only billing for $80 of revenue. The customer then pays it. We get $80. We remove $80 from accounts receivable. The remaining $20 stays in accounts receivable. This was in effect due to the damages, how we were recording the damages from the predatory pricing practice. We asked Sandra Lang, who was the controller of the Bay Guardian, and it's our Exhibit 1. You know, if it, we just wanted Sandy to look at this and confirm it, and because she was involved. So, Sandy, would you mind just introducing yourself and stating your role?
Yeah, good morning, all judges, your honors. My name is Sandra Lang. I was the controller for the Bay Guardian during this period. And as John pointed out, in preparing for the lawsuit was adamant that we needed somehow to prove that the Weekly or New Times was selling below cost, and additionally, we needed to prove what our monetary damages were. So we came up with this way to account for sales. So as John pointed out, we'd sell, the regular price for the ad was $100. We'd submit a bill to the advertiser for $80 based on the Weekly's cost or the price of the Weekly ad, which was proven either by a contract or a bill from them or something. And then we had a $20 discount that we put in other accounts receivable. And it was basically to be able to go into court, and when the court asked us, prove your damages or where are your damages, we could point to that line on the balance sheet and say those were our monetary damages.
Thank
you, Sandy. Sandy's written a very detailed
Mr. Harper,
memo.
Mr. Harper, just 1 minute. Ms. Lang, is that the extent of your testimony?
Unless you have questions, yes, sir.
We might, so Mr. Harper, hold off before you continue. Let me ask the Franchise Tax Board. Do you have any questions for Ms. Lang?
Judges, this is Brad Kragle for the Franchise Tax Board. I just have one question. Ms. Lang, can you hear me?
Yes, sir.
Can you confirm that the company no longer has any records that would show the details of these transactions as you described them?
That's correct, sir.
And could you just confirm for me what happened to those records and the timeline on that?
The San Francisco Bay Guardian was sold to San Francisco Newsprint, to the ownership of the Examiner in 2014, I think. And when we transferred all records, all electronics, everything over to the Examiner group, and at one point they wiped the servers clean. I'm not sure on whose authorization or why, but I was not notified, nor anybody else at the Guardian, former Guardian at that point was notified. So that's what happened.
Okay, well, thank you for your time. No further questions, judges.
Thank you, Franchise Tax Board. Judge Aiken, do you have any questions for Ms. Lang?
Judge Aiken speaking here. Yes, I do have one question. So, Ms. Lang, can you explain to me when the practice of reporting those discounts as accounts receivable began and when it ended?
Yeah, it began before we actually filed the suit in 2004 because we were discussing preparatory how to prove the points of our lawsuit. So it began around 2003, and it basically ended when the sale of the Guardian came through, because once we started, and on both sides, both papers survived the lawsuit, but we never got our prices back to where they should have been, because once the client was paying $80 for a $100 ad, you know, we just didn't go back to them and say, okay, case closed, you have to pay more now.
Okay, thank you, Ms. Lang. Judge Aiken speaking.
Thank you, Judge Aiken. Judge Rosas, do you have any questions for the witness?
Good morning, this is Judge Rosas. I just have a administrative procedural question. I just want to confirm whether the witness was sworn in.
Yeah, I affirmed to tell the truth and nothing but the truth.
Okay, thank you. That's the extent of my questions.
Ms. Lang, this is Judge Leung. Now, I understand that your civil lawsuit attorneys advised you to somehow provide some sort of mechanism to create a record for these discounts, for your lost revenue. Did they advise you as to how to file the tax returns too?
No, sir.
So that was no?
That's correct. No, sir. They did not advise on the tax return.
So up until the time when you started keeping track of the discounts, how did you report revenues from advertising?
We reported them as accounts receivable, and when the advertiser paid, we converted from accounts receivable to cash.
Was that the same method when you were providing discounts? Like say your $100, $80 example?
Yes, sir.
So you reported the receivable as $100, and even though you only knew you were going to collect $80.
Well, I mean, to the extent that, yeah, we right then the advertiser was only going to pay us $80 or leave us to take the $80 ad from the weekly. So we wanted to keep the advertiser, you know, and that's all.
Well, isn't it unusual to over-report income like that? I mean, you'll be paying tax on revenue that you will never receive from the advertiser.
Again, I didn't know if the court was going to order everybody to pay us up. I mean, we didn't know if the advertiser would eventually say, well, yeah, I guess I got an illegal discount here. I mean, but paramount was proving that the behavior was happening, so that when we went to the jury and we went to the trial, that we could say this is what they were doing, and secondarily proving the amount of our monetary damages. And yes, we overpaid taxes. It was killing me because we were certainly not in any shape to spend extra money, but we felt, the lawyers felt, and I felt, and we all felt that we had to prove the monetary damages. We had to somehow bring that to the forefront.
Okay, thank you, Ms. Lang. Thank you for testifying today. Mr. Harper, you may continue. Thank you.
All I want to mention is, Sandy's written a very lengthy and detailed memo, which is our Exhibit 1, and, I encourage you to read that. Again, I apologize if I can't tell you what to do, but again, it's our Exhibit 1, and thank you, Sandy. One thing that, that's totally unusual is over-reporting income and paying taxes. But the Bay Guardian, I know Sandy's mentioned we're paying taxes, but again, we're over-reporting income. But the Bay Guardian was losing so much money at that point in these years, we have a huge net operating loss carry forward going back to 2003. So, even though we were over reporting income, it still never put us in a taxable situation. So that's just a clarification, but we definitely were over reporting income. And again, like I say, Exhibit 1 is a memo that Sandy put together for us, so thank you. Okay, continuing. The company knew from the beginning that these accounts receivable were made up of unbilled discounts the accounts receivable made up of unbilled discounts would never be collected from the actual customers. The collection, if any, would have to come from a successful lawsuit against the San Francisco Weekly. This finally happened in 2008 when the Bay Guardian prevailed in its lawsuit with the Weekly. However, due to an appeal by the San Francisco Weekly in which the original judgment was affirmed, the actual settlement did not occur until 2013. With a settlement of $2.7 million. This was paid to the lead attorney trust account and distributed first to attorney fees of $1.8 million, with the balance $875,000 paid to the Bay Guardian. This amount, along with other closing activity, is reported on the Bay Guardian tax return as other income. We have a schedule here. It's 100, page 3, line 10. Respondents Exhibit A, page 3. You'll see line 10 is $1,670,000, and then we'll show 2, the bottom line settlement of net fees, $875,000. That's the net settlement after attorney fees. We'd also like to point out that we have this relief of debt item. I mean, that's a credit which was unpaid, and that becomes income. I'd like to mention also, the franchise has a real problem when we write off an asset and take a expense. They have no problem when we write off a liability and report it as income. During the course of the audit, they did not spend 1 second asking about this relief of debt income. So just a highlight. All right, continuing. The company has already recognized income of $1.9 million by recording the lawsuit settlement as income. The company has reported income of $2.8 million. That's the $875,000 they got, and the previously recorded $1.9 million, which was the unbilled accounts receivable. But the only cash they received was $875,000. To remedy the over-reporting of income and remove the accounts receivable from the balance sheet, the company took a bad debt deduction of $1.9 million. By doing so, the company ended up correctly reporting income on the actual cash received of $875,000. The FTB position has the company reporting income in the amount of $2.8 million, even though only $875,000 was received. The position of the FTB as a dissolved corporation ending up with a balance sheet asset of $1.9 million, which is worthless and uncollectible. A dissolved corporation's balance sheet should basically be 0 assets and 0 liabilities and equity. The FTB insists on only doing one side of the accounting entry. I have asked the FTB at every step of the way, the field audit, the appeals office, to look at both sides of the accounting entry. The debits and credits have to balance. The issue has been completely ignored. They refuse to acknowledge that the debits and credits have to balance. The reporting of income and the related accounts receivable was done on the advice of the Bay Guardian's attorneys to document damage due to predatory pricing. The company knew from the start of this practice that they would never collect from its customers. If they ever collected, it would be from the San Francisco Weekly and only through a lawsuit. Based on this fact, the company should not have been reporting unbilled discounts as income, in effect overstating income. I call your attention to the respondent's brief, page 14, which discusses generally accepted accounting principles. And I agree completely with the respondent's conclusion that the income is not accruable. The Bay Guardian should never have recorded as income the total non-discounted advertising revenue. However, the respondent does not follow through with what this means. Had the company never recorded the revenue and accounts receivable, the income would be reduced by the accrued income and the net operating loss carryforward would be increased. You reduce net income and you already have a net operating loss, your net operating loss carryforwards increased. Basically, overstated income of 1.9 million, which means we've understated our net operating loss carryforward by 1.9 million. Had we not over-reported the income, our net operating loss carryforward will be $1.9 million higher. The whole point of putting a balance sheet in the corporate return is to prevent taxpayers from doing exactly what the FTB is trying to do. The FTB is crediting expenses, which raises income, with no corresponding debit. They would end up creating a balance sheet that's out of balance. I call your attention to Respondent's Brief, page 11, first paragraph. Respondent notes that, as displayed in Table 1 above, we'll show you Table 1, the net income amounts reported on the income statement for tax years 06, 7 are not consistent with the net book income reported on Schedule M1 of Appellate's corporate tax return. This disparity in reporting calls the credibility of the income statements into question. I just want to emphasize that statement. This disparity in reporting calls the credibility of the income statements into question. This worksheet is prepared from financial statements that the Bay Guardian submitted before we make our journal entries. We get raw information, we make journal entries, and then we send those journal entries to the client and they book the income. For each return, our journal entries are done before we prepare the tax return. We always reconcile book income to tax income. We always reconcile retained earnings to the balance sheet. The financial statements we receive, which are part of Respondent's Brief Exhibit V, are prior to adjusting entries, with tax adjustments noted in pencil. The only adjustment each year is for depreciation, and we do not ask the client to redo their financial statements after recording our journal entries. They post these journal entries that we make before they close the books for the year. Table 1, which is doing everything to disparage our work. Table 1 is Respondent's Brief, page 7, is completely wrong and casts a very disparaging light over the validity of the Bay Guardian financial statements. We're going to great lengths to prove that our book income and tax return income does not reconcile. With very little effort, the FTB could have been able to figure out that each year was off by our depreciation adjusting entry. For example, year-end 4/30/07, the difference is $80,117, which is the adjusting entry we made for depreciation. You can see Respondent's Brief, Exhibit G, page 2, line 20. And that's exactly what's on that line. Page 2, line 20 is depreciation expense of $80,117. The most disturbing item in Table 1 is year-end 2009, excuse me, and that's highlighted. This shows income of $276,000 and a difference of $600,000. If you look at the financial statements, which is Respondent's Exhibit V, page 24, we have a book loss of $280,000. So they're showing income of, yeah, again, it's highlighted in green, it's profit loss, yeah, excuse me. So they're showing income of $276,000, and we have a loss of $280,000. That's a difference of $557,000. I do not understand how anyone doing an audit could write down a variance that large and not question at all as to what was going on. It's kind of like, does anybody review this work? So the FTB has called into question the credibility of the income statement. We would certainly question the credibility of the FTB audit staff. This is very, very poor work. My next section is on this 186 issue. So I'm not sure if we're supposed to pursue that now, or we're going to talk about this, the California section 24678.
Mr. Harper, you can talk about both of them right now.
Okay. The IRC section 186 relates to an allowance of deduction if compensatory amount which is included in gross income is received or accrued during the taxable year for a compensatory injury. Section 186B3 states injuries sustained in business or to property by reason of any conduct forbidden in the antitrust laws for which a civil action may be brought. We believe the IRC section 186B3 clearly relates to our factual situation. We would like to call your attention to the respondent's brief, page 16, paragraph 3. I'm quoting this. The judgment against New Times was awarded for unfair competition in violation of California Business and Professions Code section 17043, which is an antitrust statute. It included actual damage for lost profits and treble damages. The facts giving rise to the suit, namely New Times' unfair pricing tactics to increase its market share. That's the end of the quote. I think the respondent is acknowledging that section 186B3 applies. We'd like to call your attention. Now, this is the jury sheet, the verdict sheet. So we've highlighted item 3, where the jury found by a vote of 11-1 that the intent of selling advertising below cost was to injure a competitor or destroy competition. I'd like to point out item 4, by a vote of 11-1, found that selling advertising below cost caused harm to the plaintiff. Next, next would be items and 10, where the jury, by a vote of 10-2 and 11-1, found that the intent was to injure a competitor or destroy competition. Okay. So our position, we believe, we know taxpayer has overstated income, and to remedy this overstatement, we took a bad debt deduction. And it should be allowed. An alternative to the bad debt deduction is we've overstated income, which means our net operating loss carry forward is understated. So it's either the bad debt or the net operating loss. It's one or the other. And it has, oh, and then in addition to that, we think we've overstated income to the extent of the damages, the $875,000, which that was pointed out that I completely missed that issue. Everybody in the Franchise Tax Board missed that issue. And it was only, a memo from Claudia Lopez of your office that pointed out that to me, and everybody else. We believe our position is absolutely correct, and it's been substantiated by independent testimony from Sandra Lane, the results of our very successful very successful lawsuit for attorneys, but successful lawsuit. The proper use of double entry accounting, which again, the Franchise Tax Board refuses to do or acknowledge. And the fact that this issue has never been questioned by the IRS. I'd be happy to answer any questions, but that's kind of where we're at. Thank you.
Does the Franchise Tax Board have any questions for Mr. Harper?
Just a couple of questions, judges and Mr. Harper. Can you hear me okay, Mr. Harper?
Yes.
You would agree that the records or the source records showing the discounts, you were unable, or your client was unable to prove or produce them, correct? Because they were destroyed.
That's true. In your exhibit, it's Exhibit W. There's just basically 3 of these source records for the bad debt. Now these, these are paper copies that were used in the lawsuit, and that's why these still exist, but not all of them. The Bay Guardian, they actually used a separate accounting system, and it was tracked in a separate account. And they used a software, specific newspaper software program called Smart Publishers, and this program tracks sales. But again, when all these records were turned over to when the business was sold, the accounting records were deleted. So no, we fully acknowledge we do not have a list that builds up to 1.9 million. We've said that from the beginning.
Thank you. And just one other question. When did you find out that your client was reporting the discounted amounts as accounts receivable?
Okay, well, first off, I found out at the end. I would have told him not to do it. So again, I found out when the lawsuit was settled and they received the money. I was not involved in that decision as to how to report it.
Thank you, Mr. Harper. No further questions.
This is Judge Leon. Thank you, Mr. Kriegel. Judge Aiken, do you have any questions for Mr. Harper?
Judge Aiken speaking. No questions at this time.
Judge Rosas?
This is Judge Rosas. I do not have any questions. Thank you.
Mr. Harper? All right, this is Judge Leon. I have a couple of questions for you. Where to begin? Okay, there's a January 2018 letter from you to the Franchise Tax Board. I believe that's Exhibit T as in Tommy. And it talks about your financial statements. It also mentions that in 2008, the Bay Guardian transferred about $1.5 million from their accounts receivable account to other assets. What was going on there? What was that all about?
Sandy, you're still on the phone, aren't you?
Yes, sir.
Because again, this is where, remember, for the longest time, everything was included as a one line item in accounts receivable. And then you started separately stating the unbilled discounts as a separate line item. Judge Lane, would it be okay if Sandy responded to that? Because I think it was done just to, reclassify. So a user of the financial statements would be able to see what was what we thought collectible receivables versus what was the unbilled receivables. So
okay, this is Judge Leon. It's okay, Ms. Lang. You just reminded that you're still under oath. So go ahead. Thank you.
Yeah, I'm still under oath, and yeah, I'm basically, we were in, as we approached the trial, we decided again to highlight that amount as different accounts receivable accounts receivable that we were not expecting to actually receive on.
Okay, this is Judge Leung again. Okay, so this question is going to be for you, Mr. Harper, or if not, then to Ms. Lang. We noticed that following the lawsuit and the collection action and the settlement of the collection action, I mean, the lawsuit, you won about $16 million in damages, and after you had to fight the bank to get the money, you finally came down to about $6.5 million in damages. And we noticed that the first installment payment happened sometime December 2010, about $3.75 million. So my question to you, Mr. Harper, why wasn't the bad debt or net operating loss used for the year ended April 30th, 2011 return to record that over reporting of income in that year as opposed to the return for the taxable year ending April 30th, 2013?
Can I grab that return?
Absolutely. And one of the basic things is that my question is that first of all, you wouldn't have had lost the or had the underlying records destroyed by your buyers of a Guardian back in 2010 or 2011, and clearly you would have been able to book that or reverse those entries a lot earlier and given you the NOLs on the 2010 return as opposed to the 2012 return.
Okay, I'm going to grab the file, okay? It's not far. And it's year 4/30/10 or 4/30/11. I'll grab them both.
This is Judge Leung. So I believe the first installment was paid out around Christmas time in 2010. So it would be the tax year ending April 30th, 2011.
On that tax return, we showed we had revenue of $7,273,000. We reported as returns and allowance or bad debts $1,037,000. So on that return, we basically wrote off $1,037,000. of bad debts. And we had $2,571,000 of legal fees. I know you didn't ask that.
Correct. I did not ask that yet, but sticking with the 1,037,000 in bad debt that you wrote off, is any part of that part of the 1,925,599 that you are asking to deduct for the 2012
No,
tax year?
it wouldn't be. I mean, I'd have to ask, we'd have to go back and ask Sandy. This came from, the records we were given. All right, let's see here. Again, we'd have to go back to the source records, and I don't have an answer. I mean, the information prepared shows bad debts of $1,037,000. Sandy, I'm sure you don't recall anything about what that is going back, 9 years.
I barely recall 2014. I mean, I barely recall 2019 at this point. But I'm fairly certain that when we started getting money from the New Times, after expenses, we recorded it as revenue, but took a bad debt deduction because of all the damages we had.
To answer your question, in total, we've taken bad debts of $1,037,000 plus $1,900,000, so close to $3 million of bad debts. And we've reported revenue of that amount.
Okay, then that's the end of my questions. Mr. Harper, do you have anything else to add to your presentation before I go to the Franchise Tax Board?
Unless Bruce and Jean, is there anything you want to add? Hopefully they're still there. Let me just ask one question. Sandra, she's at work. And I told her we'd try to get her in and out of this as soon as possible. So could we let Sandy go, or do you want us to keep her?
I think the Franchise Tax Board has already questioned her, and the judges already questioned her. The Franchise Tax Board, you have no further questions from Ms. Lang, do you?
Judge, this is Brad Craigle. No, we do not, Judge.
Okay, this is Judge Leung. Mr. Harper, Ms. Hank, thank you for your service. You're free to go about your day's affairs as you wish. You can still listen in if you want to, but that's up to you.
Thank you very much, Your Honor. I will leave this conversation. However, if I am needed in the future, John knows how to get a hold of me. And thank you for your time.
Thank you, Sandy.
Thank you, Ms. Lang.
Bye-bye.
Okay, I think we're ready for the Franchise Tax Board's presentation.
All right, good morning, members of the panel. I'm Darcy Dewey, and I'm here with co-counsel Bradley Craigle, representing respondent Franchise Tax Board. The issues in this matter, as agreed by the parties and were slightly changed by the judge, but I'll say them as I have them drafted here, are whether appellant has shown that respondent erred in disallowing an increased net operating loss deduction for tax year 2012, whether appellant has shown that respondent erred in disallowing appellant's bad debt deduction for tax year 2012, and whether appellant has shown that it was entitled to a deduction under Internal Revenue Code section 186. Appellant reported a $1.9 million bad debt deduction on its 2012 tax return. Appellant claimed that the deduction arose out of a highly unusual accounting practice whereby appellant sold advertising space at a discount but booked the income at the undiscounted price. Respondent determined that appellant
Ms.
failed
Dewey,
to
this is Judge Leung. Would you please hold on for 1 minute? You're sort of breaking up a little bit, so maybe angle yourself a little bit closer to the mic so you're not breaking up. Thank you.
I apologize. So, starting again to some degree, appellant reported a $1.9 million bad debt deduction on its 2012 tax return. Appellant claimed that the deduction arose out of a highly unusual accounting practice whereby appellant sold advertising space at a discount but booked the income at the undiscounted price. Respondent determined that appellant failed to substantiate that it was entitled to a bad debt deduction and alternatively to an increased net operating loss deduction. Upon the OTA's request during briefing, respondent also determined that appellant was not entitled to a deduction for injury from an antitrust suit. The evidence supports respondent's conclusions. This case is about substantiation. Taxpayers have the burden to show that they are entitled to a deduction, whether for net operating losses or for bad debt. Taxpayers must keep records substantiating the income and deductions reported on their tax returns. Respondents' determinations are presumed correct. To prevail, appellant must be able to point to a deduction statute and demonstrate with credible evidence that it met the requirements of the statute. Appellant's unsupported statements are not sufficient. Appellant argues that it overstated income in prior tax years in an effort to prove damages in a lawsuit that it initiated in the 2004 tax year. The facts of the case are this. Appellant was a newspaper company organized as a C corporation. It used the accrual method of accounting and had a tax year end of April 30th. In October 2004, appellant brought suit for unfair business practices against its competitor, which I refer to as New Times here. In May 2008, appellant prevailed and was awarded damages for lost profits partially trebled. In August 2010, the award was generally affirmed on appeal. In December 2010, appellant entered into a settlement agreement for the award due to competing creditor claims against New Times. Appellant received settlement payments in tax years 2010 and 2012, which it offset in those years, but with legal expenses. The payments and the legal expenses were adjusted by the FTB and are not contested. Appellant claims that sometime during 2004, 2005, or maybe 2003, its attorneys advised it to track ad discounts in order to prove damages in the New Times suit. On this advice, appellant began booking ad sales into revenue at undiscounted prices, even though it did not expect payment from customers on the discounted portion. Appellant asserts that the unbilled discounts were recognized in taxable income as they accrued and that this practice continued through either tax year 2008, tax year 2012. The record is inconsistent regarding the applicable dates. According to appellant, its 2012 bad debt deduction was a write-off of its accrued unbilled discounts. I'm going to pause and make sure that everybody can hear me at this time.
This is Judge Leung. You're still breaking up in some portions. We can barely get you most of the time. So if you stick by what you were doing at the very beginning, whatever you were doing worked very well. Towards the end, you were sort of breaking up some more.
Yeah, I think I tend to lean back a little bit. So I'll just try to stay closer, or I can alternatively call in. Let me get. Can I continue? Can you hear me now?
This is Judge Leung. Yes, we can hear you now.
Okay, I'll just try to keep leaning in. So, continuing, in support of its claims, appellant provided financial statements, samples of customer accounts, and estimates of the unbilled discounts accrued between tax years 2004 and 2008. Based on the documentation provided, respondent could not verify the nature of appellant's deduction. Respondent determined that appellant was not entitled to a bad debt deduction and declined to allow an increased net operating loss deduction. Respondent made additional adjustments not at issue in this appeal and issued a notice of action which assessed additional tax of $70,000. Turning to the first issue or sub-issue. California provides a deduction for net operating loss carryovers in partial conformity with Internal Revenue Code Section 172. Respondent may redetermine taxable income in closed tax years in order to recalculate the correct net operating loss carryover to the year of deduction. So if appellant overstated its income in prior years, that would bear on the correct computation of the net operating loss. According to appellant, the unbilled discounts were actually accrued damages expected from the new time suit. In other words, they were contingent litigation gains. Generally, litigation gains are not reportable for tax purposes until final disposition of the suit, for example, settlement. Any income accruals reported before the 2010 settlement in this case would have been improperly overstated income that we could correct with a recalculation of the net operating loss in 2012. For appellant to prevail on its claim to an increased net operating loss, however, it must prove that it actually accrued the unbilled discounts in taxable income and prove the amount of the gains accrued for each taxable year so that we can compute the 2012 net operating loss correctly. Appellant has not met its burden of proof. Appellant provided income statements. The 2012 statements show only that its bad debt deduction consisted of $1.7 million from an expense account labeled bad debts and $200,000 in advertising revenue. Nothing in the statements refers specifically to advertising discounts. The income statements for tax years 2006, 2009, 2010, and 2011 also report expenses similarly labeled bad debts, which appellant excluded from income. In view of this, it's possible that if appellant did accrue the unbilled discounts, then it also already excluded them on its tax returns. We simply don't have enough information to know. Appellant provided balance sheets. The balance sheets are similarly unhelpful. Appellant states, for example, that in tax year 2008, it moved the accrued discounts on its balance sheet from accounts receivable to other assets and then ceased accruing discounts. Based on appellant's representations, we should be able to tie the $1.9 million deducted to the $2.3 million moved to the other asset account. We cannot. At the end of tax year 2011, appellant's other asset account was $1.6 million, which also cannot be tied to the bad debt line. So the balance sheets are inconsistent with appellant's statements. The customer records provided by appellant demonstrate only that appellant was in the practice of providing discounted ad sales. They do not demonstrate how appellant reported the income from these sales for tax return purposes or for financial accounting purposes. In fact, many years covered by the customer records predate appellant's alleged implementation of the accounting practice at issue here. Appellant's officers estimated that it accrued approximately 2.3 million of discounts in income between tax year 2004 and 2008. The estimate does not match the bad debt deduction and is not tied to the financial statements or tax returns. Appellant's controller, Sandy Lang, asserts that she used the accounting practice from, according to her statement today, 2003 through possibly 2014. Respondent could not verify Ms. Lang's statements as they are not supported by documentation. The accounting practice described by appellant is highly unusual. Generally accepted accounting practices provide that contingent gains are not accruable. They are too contingent to accurately reflect income. And this is in parity with the tax rules. The result of this practice, as discussed, is to report income earlier than necessary, exposing the taxpayers to a real risk of increased tax expense. Given this, respondent would expect appellant to exercise a high degree of care by maintaining contemporaneous documentation to ensure that the company was able to prove its position. Furthermore, appellant has had trouble pinning down the dates applicable to this matter. Inconsistent statements in the record refer to dates ranging between 1999 and 2013. Appellant argues that principles of double entry accounting alone are sufficient to prove the accruals. Appellant is mistaken. Deductions are granted for the underlying economic activity tracked on the financial statements. The taxpayer must be able to prove the nature of the economic activity represented by its financials and demonstrate that it is deductible. The record simply does not adequately substantiate appellant's claims. Therefore, appellant has not shown that it should receive an increased net operating loss deduction. Turning to the second issue or sub-issue, California provides a deduction for bad debts in conformity with Internal Revenue Code Section 166. To prevail, appellant must show that it had a bona fide debt which became worthless during the taxable year. A bona fide debt arises from a debtor-creditor relationship based on a valid and enforceable obligation to pay a fixed or determinable sum of money. A debtor-creditor relationship arises where the parties intend, at the time of the lending, that the lender will collect and the borrower will repay an amount due. According to appellant, it never intended to collect the unbilled discounts from its customers, and appellant did not provide records showing otherwise. Therefore, appellant did not claim a bona fide debt with its customers. Appellant claimed that expected payment in the form of damages from New Times. New Times clearly did not intend to indebт itself to appellant. However, in some limited circumstances, a debt can be created by operation of law. As more fully explained in respondent's opening brief, respondent could not find precedent treating the underlying activity in the New Times lawsuit as giving rise to debt by operation of law. Secondarily, even if a creditor-debtor relationship were established with New Times, the debt would have become fixed and determinable at settlement, after which it was fully paid and never became worthless. Therefore, appellant failed to even allege facts that it would qualify for a bad debt deduction. Turning to our third issue regarding Section 186. I would like to correct statements of law in respondent's briefing. Respondent proceeded on the assumption that California conforms to Internal Revenue Code Section 186 for purposes of the corporate tax. Upon further review, respondent's position is that California does not conform to this section. California instead has a standalone provision relating to awards from antitrust suits. Revenue and Tax Code Section 24678 provides a limitation on the taxation of an amount of damages received or accrued as a result of an award in or settlement of a civil action brought under Section 4 of the Clayton Act. The amount must be for injuries to the corporation's business or property sustained as a result of violations of the antitrust laws. If applicable, the tax imposed is limited to the amount the corporation would have been liable for if it had reported the damage award in income ratably on a monthly basis for the duration of the period in which the injury was sustained. California's provision applies only to damages that result from a claim brought under Section 4 of the Clayton Act. Appellant prevailed on its action against New Times for violations of California Business and Professions Code Section 17043. Appellant did not bring a claim under Section 4 of the Clayton Act. Therefore, California's tax limitation is not applicable. In summary, the taxpayers did not meet their burden to prove that they are entitled to an increased net operating loss. The taxpayers failed to allege facts qualifying them for a bad debt deduction. And finally, California does not conform to Internal Revenue Code Section 186 for corporate tax purposes, and California's standalone provision relating to antitrust damages is not applicable. For the reasons discussed here, respondent respectfully requests that your panel affirm respondent's notice of action. I'm happy to open for the questions.
This is Judge Leung. Mr. Harper, you have any questions for Ms. Dewey?
Question every step of the way, you know, why won't they give us journal entries? You know, I know that's not their job, but they just sit back and say, you know, we don't care what the other half of the entry is. I mean, that seems, you know, the whole basis of the whole country is double entry accounting, and the Franchise Tax Board doesn't seem to go by those rules. So, you know, what's the other half of your entries? You've acknowledged that we should never have accrued income. So what's the other side of that entry?
This is Darcy Dewey for respondent. In response to your question, I refer you to our argument stating that the deduction is for the underlying economic activity. So the appellant's burden of proof is to show what that underlying economic activity was that would give rise to a deduction.
So you didn't answer my question either. That's the, you know, at least you opened your mouth and said something. Nobody else would ever say anything. You know, debits and credits are supposed to balance.
Okay, thank you, Mr. Harper. This is Judge Leung again. Judge Aiken, any questions for the Franchise Tax Board?
Just Judge Aiken speaking. I think I have just one question, and that is just understanding a little better why it is that FTB is maintaining that they would not be entitled to an increased net operating loss carry forward. Is it, you're saying it's a substantiation issue? Could you explain that a little more for me? Franchise Tax Board?
Yes, this is Darcy Dewey for respondent. In response to your question, that's correct. The FTB's position is that the appellant failed to substantiate that they actually overstated income in the past years. They say they implemented an accounting practice, but we have no evidence of that other than unsupported statements by appellant.
Judge Aiken speaking, and just one follow-up question to that. Looking at their financial statements, you do see that they said in 2008, I think it was, they began reporting it in other assets. You do see the increase and then the decrease of those amounts. Is it your position that that doesn't substantiate that those increases in the other assets were actually reported as income during those years? If it helps, I could direct you to, it's actually your Exhibit V, Franchise Tax Board, Exhibit V for Victor. And I'll get you a page number, one moment. So examples would be page 6 of 44. Which would be their balance sheet for the tax year ending April 30th, 2010. Oh, and let me back you up to the one before that. So the page before it, page 6 of Exhibit V. So if you look at, I'm sorry, page 5. If you look at page 5 of Exhibit V, you can see their other asset balance is $2,215,474 for the tax year ending April 30th, 2010. I'm just waiting to give you a chance to find that.
I'm there with you, yeah.
Okay, and then if you flip to the next page, so page 6 of Exhibit V, the same line, the other assets, you see it increases to, it decreases that year to $1,246,484. And I think that's the year that they're saying they received the first payment, so they booked a bad debt expense. But if you then flip to the next page, which should be page 7, I think you see it go back to $1,606,000.
Correct.
So I guess my question is specifically in those years that you're seeing the increase. So the increase from tax year ending April 30th, 2011 to the tax year ending April 30th, 2012, you see that increase of it's approximately 400,000. Is it your position that you don't know, I guess, that was reported as revenue in that year?
Right. It is our position that we're not certain that was reported as revenue. It may have been excluded as revenue in some other fashion, but primarily our position is that we don't know what those numbers represent on the balance sheet. What is the underlying activity giving rise to those numbers?
Okay. Judge Aiken speaking. Thank you. That helps.
This is Judge Leung. Judge Rosas, any questions for the Franchise Tax Board?
This is Judge Rosas. Bear with me as I take a look at my notes here. I do not have any questions. Thank you.
Thank you, Judge Rosas. This is Judge Leung. Ms. Dewey, I got a couple of questions for you. First, I want to apologize for treating you as a witness a minute ago. I did a little misstep there, but my questions to you are a couple of questions. Let me get one out of the way that's more procedural than anything else. The taxpayer raised the question of why this case was sent back to New York and came back to Sacramento with no apparent outcome from New York. Can you explain what happened there?
Yes, and I did look for the rationale in the record. It's not clear to me what happened, but the FTB does frequently move accounts due to workload, due to people leaving the FTB. So it's not surprising when something does get transferred on occasion.
Okay, this is Judge Leung again. My second question is, you argue that there's not enough substantiation. So what exactly were you looking for? You're looking for the actual invoices, contracts? What were you looking for to substantiate these amounts?
Right. So I think that ideally what we would look for, what would ideally prove this would be, yes, the actual invoice showing how the customers were billed, and that tied to how the journal entries reflect that billing and reflect the booking into accounts receivable and other assets on the balance sheet. So we just need to be able to follow the invoices and the accounting practices through to the tax returns all the way through.
This is Judge Lynn again. Wasn't the judgment and the trial record for the underlying Bay Guardian lawsuit, was there enough information there for you to, I mean, they had to prove their damages to the court and to the jury. So was there enough exhibits there for you to look through to figure out what was going on?
No. This is Darcy Dewey for respondent. Our position is that we didn't have enough information based on the on the judgment and the appellant documents received. The case was about whether or not was about damages in unfair business practices. So it looked to us like they had considered many different factors which are not relevant here, such as competition in the market. It wasn't clear what the foundation of the experts was based on, what documents they found that their expert witnesses were based on.
Okay, this is Judge Lynn again, and I guess my final question is regarding the differences between Revenue Tax Code Section 24678 and Internal Revenue Code Section 186B3. Other than your assertion that the California section only applies for damages arising from a federal lawsuit under the federal antitrust laws, what other differences are there between the California section and the federal section?
So this is Darcy Dewey for responding again. To be clear, I believe your question is what are the differences between IRC section 186 and the California provision section 24678. Is that correct? Okay. So they
This is Judge Lynn. Yes, that's correct.
Sorry, I just saw you nod. I apologize. So they apply a different mechanism in order to come to kind of similar results. 186 allows a deduction for awards from a antitrust suit, and California applies a limitation. So there's a slightly different mechanism there. And the 186 section is kind of complicated with respect to how do you apply that. And I think California is a little simpler, but it also has some complications to it. The standards are also different. The applicability is also slightly different. For example, Internal Revenue Code Section 186 applies. Let me just check my notes for just a second. Basically, it applies to a suit that could be taken under Section 4 of the Clayton Act. So we look at whether or not the taxpayer's claim under Business and Professions Code Section 17043 could have been taken as a claim under the Section 4 of the Clayton Act, and the BFTB concluded that it could not. For purposes of the California statute, the claim actually must be brought under Section 4 of the Clayton Act. So it's a little bit more clear cut. We don't have to do the analogy of 17043 to another antitrust suit, basically. And that the 186 was more fully described in our additional briefing.
Okay, thank you. Mr. Harper, you have 15 minutes left to do your closing statements.
You lied. Can I, first, Judge, I just would want to respond to one of the questions you asked about the Franchise Tax Board having access to the court records, of which the respondent answered no. I call your attention to my Exhibit 4, which is a correspondence between me and the appeals officer in New York, where we talk about, you know, again, it's the third paragraph where we're talking about the only document signed by a judge is an original judgment for $15 million. These two events occurred in 2010. And I state, I know you have access to these documents as Steve Parada, he was the second FTB officer at the hearing, made reference to the case during our hearing. So she's incorrect saying that they never looked at it or never had access to it, because he certainly looked it up, and he was one of the appeals officers in New York that, again, we never heard from. Also, her statement, you know, the concept, because that's why I asked, why are we going to New York for this appeal conference? So I called and they said, well, due to workloads, we're transferring it to an area that does not have a high workload, which all makes sense. But why would you then hear the case, trade correspondence, two people hear the case and exchange correspondence, and then not issue a report? You know, if you're trying to even out workloads, all the work was done in New York. All they had to do was write a report. And, you know, I still question, I hear her answer, and it's evening out workloads, but all the work was done. All they had to do was write a report. So somebody didn't like what they were going to say. I'm sorry. That's the way I feel. Okay. Now, the only way to generate accounts receivable, which is a debit on a balance sheet, is through a credit. So the only place to put a large credit is revenue, which is an income statement item. There's no other. So the accounts receivable came from somewhere, because it's on the balance sheet and it's been there consistently. Judge Aiken pointed out how it goes up and down. You know, it came through revenue. The whole purpose of a financial statement is to summarize thousands of transactions. Again, the respondent says, you know, they wanted to look at invoices. That once did they ever ask to look at a single invoice? Everything, you know, they look at bank statements. Bank statements are the key to any audit. That's cash is the only thing you can't make up or pretend doesn't exist or pretend does exist. You get a bank statement, that you're pretty much done with your audit. I try not to ramble but I don't. But again, you got to understand, this is a small business, you know, and they don't have a huge accounting staff. So, you know, when you ask for this stuff, you know, the financial statements, they're very accurate, and we review them, we go through them. And again, we've shown you where the Franchise Tax Board has taken liberty with this, basically trying to disparage our balance sheets, where they're as much at fault for the work they did. Finally, on this section 24,678, I'm looking right at it. It says to me, forbidding in the antitrust, then the tax attributable to the inclusion of that amount in gross income for the taxable year shall not be greater than the aggregate of increases in taxes which would have resulted if that amount had been included in gross income in equal installments for each month. So if we're talking about $875,000 of income, you do a quick calculation over, we'll just say, well, say 9 years, that's what, 100 months? We'll divide it by 12. I'm trying to break this 875,000 into months, because that's what it says.
$8,000 a month.
This is $8,000 a month, or $96,000 a year. So We've got net operating losses going back to 2003, where the smallest amount, I mean, it's 153,000, 390, 50, 320, 104, 272. So if you calculated a tax attributing this income back to those years, the tax would be 0. So I think, first off, I think it's excluded under 186, the federal provisions. And then if you did the calculation, it would be excluded under the California provision. And I'm looking right at it. The tax attributable to the inclusion of that amount in gross income for the year shall not be greater than what the tax would have been had it been redoubled in each month. So that, I don't know. So I think even looking at the California provision, the tax result is 0. So, pardon me. Excuse me. Again, I just fall back to our conclusions. We've got testimony of Sandra Lang. She's totally independent of the Bay Guardian. We tell you exactly what we do, and we get the standard comment from the franchise tax board, unsubstantiated comment. I've heard that so many times, in response to my explanation of what we did. This is a small business. I would ask, the big question is, where's the money? This is a business. They're basically saying there's $1.9 million somewhere. And this is a business that was a business that worked strictly on credit cards and checks. And that means the funds had to go through a bank. And the franchise tax board, through their audit, had every bank statement for the year they were looking at, the year before, and the year after. And there's no record of anything, there, because it was never received. We booked something in error. We reversed it to correct that error. They did this. They took this very unusual plan based on attorney's advice, which turned out to be very good advice, as it was one of the key elements in winning their lawsuit. There are situations where records don't exist. Houses burned down, deeds are gone. You can get a deed. Construction records are gone. They're out of business. There are situations, and this is one of them. We told you exactly what they did, or how this stuff was, the software program that generated it. We gave you 3 examples, which are in the respondents' exhibits. And again, those survived because they were actual hard copies, used it in the trial, and we have that for hundreds of people. The last thing, this double entry accounting system is crucial. And I keep going back to it. If the franchise tax board would just look at it, which they refuse, they have to have the debits and credits have to balance. How can you end up with a dissolved corporation with a $1.9 million worthless asset on its balance sheet? I think we've absolutely sustained our claim. We've acknowledged that we don't have a list of the bad debts as an alternative. We've certainly shown that we've overstated income, and if not through the financial statements, through Sandy's testimony, and she was right there doing it every day for all those years, and nobody, nobody made her do it. She was doing it based on sound advice from attorneys. I really don't know what else I can add. Thank you.
Thank you, Mr. Harper. This is Judge Leung. Any final questions from our judges? Judge Aiken?
Judge Aiken speaking. No further questions from me.
Thank you. Judge Rosas?
This is Judge Rosas. Mr. Harper, I just have one question. You made reference to documents that are no longer available. You made reference to the court documents that were available, which were provided in this matter. Question, did you attempt to go to the courthouse to obtain copies of the court records and court files in the underlying matter?
I'm sorry, you asked me if I went to get the records?
Correct. I'm trying to figure out if, for purposes of this appeal, if an effort was made to obtain records, court records of the underlying case.
I did not.
Do you know if anyone else, for purposes of this appeal, made an effort to obtain such records?
It's just a verdict, right?
Now, I'm not sure when you say for purposes of this appeal, as I told you earlier, I know the Franchise Tax Board, the Steve Parada, he looked at them. And he was, he's in Sacramento. Made reference to the documents in our hearing with the New York City Franchise Tax Board. They had two people. One was in New York City, and the Steve Parada was in either Sacramento or Rancho Cordova. Which again, I didn't understand. You transfer a case to New York, and then it's heard by somebody in Sacramento.
Mr. Harper, I understand your frustration and understand you're referencing matters that took place in the underlying audit. But to get to the heart of my question, I'm trying to figure out, for purposes of this current appeal before the California Office of Tax Appeals, was an effort made to obtain records that were filed in the underlying lawsuits?
No.
Thank you, Mr. Harper. That answers my question.
Thank you, Judge Rosas. This is Judge Leung. As I mentioned earlier, the judge is going to take a brief break for about no more than 5 minutes. Please do not go away. Do not disconnect. Stay on the line. We'll be right back. Thank you. Okay, this is Judge Leung. We're back on the record. Mr. Harper, any other final words? Maybe 1 or 2 sentences before we wrap up.
No, I'm fine.
Thank you. This is Judge Leung again. We decide that there's no additional briefing needed at this point. We are closing the record. Thank you, everybody, for attending this hearing. We will endeavor to get our decisions out within 100 days of the making our decision. And again, thank you very much. And the next hearing is scheduled for 1 p.m. and OTA will now be going on a brief recess. Thank you.
Thank you.
Thank you, judges.